Why stocks are extending their losses at this time right now because of these bank contagion fears, with the Dow turning negative for the week as well. Joining us now is Bullseye Option Chief Market Strategist Alan Nookman. Alan, it's great to have you on today and to dig into this a little bit more, because this has been a market that's been going back and forth, back and forth. First, we hear from the government that everything's okay. The market is jittery about what could happen moving forward, and it may take some time for something to happen if it does. Having said that, you've got a Fed that's got to make a decision as well, what it's going to do on interest rates. So there are a lot of forces working here. Your thoughts on where we go when we close today and start a fresh page on Monday?
Well, net, that's a lot of information to digest, and the markets have moved forward, and we're actually positive in the S&P. We're above where we were at the close on Thursday when this all started to unwind. So I view that as a positive. I'm a price guy. I'm more above how the market's going to move, not why. And we've got a lot of positive reaction to what could have been, catastrophic. So if you look at the big picture, XLF, the ETF, that tracks the financials and the big banks, that's down about 15% off of its highs from, in the near term here. But it's still 500% above the 2009 lows when the banks were really in crisis.
Is today, though, fundamentals or a lot of concerns about volatility around triple witching day, which, as we know, is some of the expiration of some of the options, which further creates volatility?
Well, volatility has actually come down significantly. The recent high was 31, which is still a far cry away from the 90, the 100 that we had when we had the real banking crisis. But we have had a sharp decline in the last week as the markets have stabilized. Now, we've seen some price movement, but it hasn't been significant. It's been up 1%, down 1%. So you've got to focus on the percentages, not the points. The points obviously are a lot higher now than they were 20 years ago. But it's still small moves in percentage terms, and we've seen rates come down. Inflation numbers this week were positive. Crude oil's back below $70 a barrel. So there's a lot of there's a lot of green shoots to look at here, and now we just have to wait to see what does the market do over the period of the next weeks with this unfortunate incident last week.
Alan, really quickly, we've been debating if the Fed doesn't raise rates, if it goes zero at its next meeting, is the market going to love that because, hey, rates have stopped moving up, or is the market going to say, oh my gosh, what does the Fed know about the next shoe to fall with banks?
Well, we'll have to see, but the markets had priced in about a 50-50 chance of a little bit of a bump. But for us as traders, we're at the end of the road of this rate hike cycle. We're at our destination. The futures markets are telling us where we're going to be. And if you look out here at the end of 2023, rates start to decline down to 4%, and then short-term rates go down to 3.5% in 2025 on out. So we've moved past that. We're focused on other things. And like I said, that could be a positive. For me, it's important to talk about what hasn't happened as opposed to what has so far. And we're at the 1-year anniversary yesterday of when this rate hike cycle started last year. And the S&P is only 10% lower in the last year of trade, even with that many hikes. So you could look at that as glass half full, not half empty, as we talk about St. Patrick's Day.
I like my glass half full, Alan Nookman. Thank you. Great to see you. We appreciate it.
Thank you.
Well, speaking of that, we've reached a pint of no return. Two worlds colliding in your local pub. March Madness and St. Patrick's Day. We'll take you there live next.
At Amica, we know what happens.